Good afternoon and welcome from PSG. My name is intrinsic, the resident equity analyst, and I'll be taking you through our gold miners investment case. With the recent outperformance of gold, and we believe this is due to the wider inflationary risk environment brought on by Federal Reserve support come in the form of reduced borrowing rates, as well as the increased printing of global currencies through other central banks, we believe at PSG it was time to take a deeper dive and look into our gold miners investment case. The key drivers for higher gold prices include Fed stimulus, rising US debt to GDP ratio, the flat US yielding curves, as well as negative real rates. We believe have all worked in global synchronicity to cause a global inflationary risk environment whereby gold has shined. The gold miners index is up 27.31% year to date. The gold price is up 20.04% year to date, whereas the CAPSWIX is down 2.72% year to date. 2020 has been an extremely challenging year for all companies, and this has been mainly brought on by the COVID-19 pandemic as well as subsequent lockdowns around the world. We believe that heightened political US risk as well as negative to flat yielding fixed income instruments have all served as tailwinds to gold. We believe that stronger gold price and a weaker dollar are going to be consistent in the short to medium term. And so we think that as investors look to safe havens and other appropriate hedging instruments, that gold and gold miners' profitability should be the first beneficiaries. As you can see below, this is a graph of the gold price as well as the inverted 10-year yield bond of the US. And what you'll find is there's a quite high correlation between as bond yields drop, gold prices rise. In the slide you can see in front of you now, we'd like to kind of highlight the increased contribution of gold miners in the gold CAPSWIX index. As gold price has risen and gold miners have continued to outperform, we've seen that gold miners have gone from a 2 to an 8% contribution in the wider index. Within this mean revisions table, I'd like to highlight the EV/EBITDA multiple, the dividend yield multiple, as well as the free cash flow yield multiple. What you'll notice that on EV/EBITDA basis, AngloGold is currently trading at an 8% discount to its 5-year average, whereas Gold Fields is at a 20 or 17% premium to its 5-year average. Would also like to highlight that both dividend yields, both for Anglo and Gold Fields, aren't where we would like to see them both at, but this is, we believe, will increase as free cash flow yields increase, as profitability increases from sustained realized gold prices. On the slide, I'd just like to highlight that in FY21 we're anticipating Bloomberg is an 1884 gold price, sustained gold price, which we believe if that is true would on an EV/EBITDA basis, value AngloGold at a 3.3% or 3.3 multiple, which is very, very cheap by our calculations, as well as Gold Fields at a 4.1 EV/EBITDA, which is very cheap by our calculations. We also highlight AngloGold's superior free cash flow yield at 11.60% and Gold Fields 6.3% free cash flow yield for FY21 if Bloomberg consensus gold prices are realized, and which we know notoriously both dollar and gold forecasts are notoriously hard to get correct. On a balance sheet basis, I think what's very key to highlight is that we anticipate gold net debt to EBITDA ratios falling quite dramatically, with both Gold Fields and AngloGold reaching net profitability or sitting in net cash as early as FY21. On a geographical exposure basis, I think it's very important to highlight that following the subsequent deal that AngloGold did to dispose of all of their SA assets, which were at 12.8% in FY19, will fall to 0%, completely absolving them of the South African risk environment, which we believe is net positive, making AngloGold, although listed in South Africa, a purely international play on the gold price, which we believe is very, very net positive. And Gold Fields currently has a 10% exposure in terms of productivity to gold in South Africa. On a margin analysis basis, I think this kind of highlights out the key tenets to our investment case, and that is that we believe that if total cash costs remain flat and even down if the dollar remains weak, and gold realized prices are elevated as is anticipated in FY21, that AngloGold and Goldfields should become quite significant cash cows, both eliminating all of their debt and sitting in a net cash basis by FY21. Again, bolstering the case for either buybacks within the market or perhaps a special dividend to investors. And finally, our recommendation. We at PSG have always shied away from investing in gold and gold miners, as we see them as non-productive assets that are mainly driven by speculation buying. The troubled current economic backdrop, as well as safe haven instruments, yielding zero to negative, we believe are all great tailwinds with regards to the gold investment thesis. We believe the intrinsic value at current gold spot prices is still there for gold, and we believe that further stimulus coming from the US with the new democratic government in power should come through in FY21 and should further bolster the case for inflationary risking and hedging. Thus and all, we've basically come to the understanding that we're upgrading our underweight positioning in these counters to a neutral, but maintain our underweight stance on the sector as a whole. We prefer AngloGold relative to Goldfields, given its exposure to good quality, lower cost mines and lower risk geographies, and a more attractive valuation. In our opinion, AngloGold is better positioned to deal with the environment with current spot gold prices if current spot gold prices cannot be sustained. If you're interested in this trade, please speak to one of your financial advisors or contact our dealing desk. Please take a moment to acknowledge this disclaimer. Thank you all and have a great day.